what is a pre-existing relationship? The easy answer to that is family, friends, work colleagues, people that you went to college, school with. Those are people that you would have a pre-existing relationship with. Where it gets a little gray and where I get a lot of questions in this as well.
Welcome back, everyone, to the Passive Road to Retirement. I'm your host, Andrew Jarrett. Today, we are joined by Kyle Swafford. Kyle is an attorney at Robinson Frantzman LLP in Atlanta, Georgia. He represents private equity clients in the merger and acquisition of distressed assets and companies, and the turnaround of corporate operations. He represents real estate investors in acquisitions and dispositions of multifamily and self-storage assets, including due diligence, preparing purchase and sale documents, reviewing title and any survey issues, and negotiating financing documents. He also represents real estate investors in the negotiation and formation of joint venture partnerships with equity partners to purchase and operate commercial real estate and corporate assets. Kyle, welcome to the show.
Awesome. Thank you, Andrew. I really appreciate it. And before we get going, I know that you probably have a lot of people that you were looking to interview as well. And I wanted to thank you for your time and having me on. I really appreciate it.
Oh, absolutely. No, it's a pleasure to have you here. So appreciate you taking the time out as well. So now maybe you can just kind of give, those who don't know you a little background and how you got into, becoming an attorney and a real estate attorney at that.
Sure. Well, I always knew I wanted to be an attorney. I joke about this, but I do mean it. When I was like 10, I think I watched Liar Liar with Jim Carrey with my parents and just thought it was hilarious. And I was like, well, I want to be an attorney, but ever since then, my life kind of always felt that way. I wanted to know what the rules were, why they were the rules, what was the point behind it. And I just kind of felt like everything that I was interested in kind of grew in that direction to be an attorney. I knew that I wanted to be more of a business attorney, a transactional attorney, a corporate attorney. Mm-hmm. There are a lot of people that like the litigation side of it. And, a lot of my friends that are, very sophisticated, knowledgeable and great attorneys in the litigation space. I find it more valuable to never get there as opposed to being good when that time comes, right? Like I would rather have prepared a joint venture agreement that, precludes certain matters so that my client can't get sued versus knowing how to represent him when he does. That I don't know, maybe that's silly, a way of looking at it, but that's how I view litigation.
I'm sure your clients would prefer that too.
Right, exactly. Right. So I always knew that I wanted to get into the more corporate side of it. When all of my classes in law school would speak to that. When I got done with law school at Mississippi College School of Law, where I clerked for a Mississippi Supreme Court justice in my final semester, I moved on to Gainesville, Florida for University of Florida's tax law school program. So I have a whole year where I specialize specifically in tax. And while a lot of it was tax centric, you realize how much of the corporate restructurings and the beginning phases of corporate development kind of are woven into the tax policy. So it's kind of like you were getting an extra year of corporate governance as well. And then I slowly found my way into commercial real estate. For a time there, I was representing clients in litigation against the IRS. And I guess once I had my fill with the IRS, I turned my sights on the SEC. I don't really know why I'm such a madman, but I got into commercial real estate and I love it. I think it's a great space, particularly the multifamily circle. You and I have talked about this, offline, but to anyone listening that's looking to get in this space or people that are, already in it would attest to this. The circle is a lot smaller than you think it is. Mm-hmm. And the amount of people, whether they're lenders, brokers, sponsors like yourself, Andrew, property managers, like everyone kind of knows somebody. Like the degrees of separation are a lot smaller than, maybe in other industries or matters. Yep. And, it's just really fun. It's a really fun group of people to constantly work with, people like yourself and other individuals. It's not this cutthroat environment like, stock brokering or anything like that. Everyone's on the same team. That's why you have a GP team, right. not a GP member. Right. And once you once everybody realizes that teamwork, camaraderie component of it, you just begin to realize the wealth and the growth and everything kind of spread from there. So I just love this space. Lucky and blessed to be here, and look forward to constantly meeting new people in the area, whether they're, a client or, anything like that. I'm just always happy to continue to talking and networking in this environment. And I've yet to come across anybody that I was like, I don't know that you're cut out for this yet. Everyone's really fun.
That's a great point. I was thinking about that as you said that. My transition from single family to multi. I mean, when you're single family, you're pretty much all on your own.
Oh yeah.
Multifamily, you can't do it without a team. That's totally correct.
Yeah.
Even
Absolutely.
whether it's underwriting, raising capital, having an attorney on your team, CPA. I mean, you need a team for sure.
And it's funny you say that too, because I always thought about this, like episodes of Shark Tank where someone's coming in there and they're asking for a raise for a 20% stake. And the shark's like, no, I want 40. And everyone's and everybody is like freaking out. Oh, I can't get 40% away. And I'm sitting here like, why? I'd rather own 5% of a watermelon than 100% of a grape. Like, what are we talking about? Right. The whole team aspect makes this thing happen so much more efficiently. And,
Right.
I think you kind of see that in the multifamily space, so the teamwork part of it. Yeah. I just never really got that mindset of keeping more of it, and
Yep.
Yeah.
No, I totally agree with you on that one. So now getting into commercial real estate, the burning question that you probably get, and I get from a lot of people, 506B versus 506C. The major differences. If you don't mind maybe going through those for us.
Yeah, not a problem at all. So to kind of get to that point, I want to state first, some people tend to think that to syndicate, there's some sort of threshold barrier, whatever that may be. Maybe it's the number of investors that the sponsor is going to have, or maybe it's the amount of the raise. Like, oh, I can joint venture at $300,000 and then I'll syndicate, $500,000. There's not this, while there is no bright line rule per se, it's really about whether you're issuing a security or not. So before we kind of get into the syndication side, I want to explain why you get there. So if you have investors that are seeking any sort of profit ownership or distributions of any kind based on the work of someone else, i.e. you're issuing a security that needs to be syndicated. So now that doesn't mean that you can't have people in a joint venture that are bringing the capital, but they need to have an active management in the company. And what I mean by that is, they need to be on those monthly calls with each other and, are we going to do this? Are we going to do that? Whatever your renovation plan may be, or refinance may be, or what have you. I don't know what your business plan calls for. They need an active role in that management. An active role would not be a yearly vote on some sort of matter. I wouldn't even say it would be quarterly, So yeah. I just wanted to mention that you get to syndication by way of issuing a security, not by some amount of investors or some sort of monetary reasons. But just having said that, the difference in the 506B and the 506C largely is 506B allows for accredited and non-accredited, or a way I remembered it when I was starting out is 506B is for both accredited and non-accredited, whereas 506C is only for accredited. That C there kind of sticks. So that's the way that I look at it. With a 506B, you can have as many accredited investors as you'd like, but you can only have up to 35 sophisticated but non-accredited investors. And you're not allowed to advertise on any sort of social media or electronic presence the offering itself. You must have a pre-existing.
Did you describe the sophisticated investor too, real quick, just for people?
I was going to loop back.
Okay.
But yes, and the final point to a 506B is you must have a pre-existing relationship with these and with this group of investors or your network. So kind of getting back to, well, what's a sophisticated, non-accredited individual? Well, it's anyone that's not an accredited individual. So someone that's accredited, for example, would have $1 million net worth, excluding their primary residence. Or if they're single, they made $200,000 for the last 2 years with the reasonable expectation of making $200,000 this year. If they're married, it's $300,000. That's your typical accredited investor. You could have these entity accredited investors that have 5 million net worth, or their specific trust institutions or banking institutions or fund institutions like retirement programs and whatnot. But typically when we're talking about an accredited investor, it's an individual meeting those net worth requirements. So a sophisticated but non-accredited investor would be someone that perhaps has the disposable money, has been in the finance world before, is at least educated in the current economy of affairs, and understands the offering that you're describing. Someone like maybe me, for example, I haven't made $200,000 3 years in a row yet, or with the expectation of doing so. So I would not be an accredited investor. However, I would be sophisticated. And that's not because I'm an attorney and draft these documents. They're just throwing that out there. I would not say that a sophisticated investor is someone that in your neighborhood who just inherited $750,000 because of their mother's life insurance policy, right? Like that's not quite what we're talking about here, because while that person may have the funds that they, could lose, do they fully understand the risks and disclosures that are going into and that are inherently present in commercial real estate investing? That's kind of the key that you want to look for. Now, I'm not suggesting that, you got to give every investor some sort of test to make sure that they know what you're talking about, right? Or
Right.
Do you know what the current interest rates are? What was the Fed saying this week? I'm not saying that you need to do that, but I think that when you're doing a 506B, which again is with people you have a pre-existing relationship with, you kind of know the ones that can afford the risk and not are sophisticated enough to understand what's going on, because that's probably the ones that you would have gone to anyway.
Mhm.
As you probably did yourself when you were getting started, a lot of books and coaching says, okay, name 20 people, name the first 20 people that come to
Right.
mind that you think would, be into your commercial real estate investing dream, right?
Yep.
I doubt of the 20 people that you wrote down, any of them would not be considered for sophisticated in this space, right? You probably wrote down people that you knew you could go to that would at least understand the conversation to begin with. So you kind of use good judgment there. Now, as far as we're talking about what is a pre-existing relationship, the easy answer to that is family, friends, work colleagues, people that you went to college, school with. Those are people that you would have a pre-existing relationship with. Where it gets a little gray and where I get a lot of questions in this is, well, what about someone that I met recently, or I met at a conference of some kind that wants to kind of get in on the deal? I will say this: the SEC has yet, nor will they probably ever, issue some sort of guidance defining a pre-existing relationship, because the nature of human interaction is so on a case-by-case basis anyway. How do you define friendship? How do I define friendship, right? Like it's going to be different in every way, right?
Right.
So what we have always recommended to our clients is what we call like a 3-touch rule. So you meet somebody, and whether it's through your website or some sort of interaction, you just mentioned that you're in commercial real estate. They want to hear more about that. You set up an initial call where you find out more about them. What is their occupation? Are they married? What's their spouse's occupation? What are their real estate investing goals? What are their investing goals, period? Do they currently have any investment properties? What's their net worth? Things that you would probably know if you had known this person through college, work, or otherwise, right? So that's the first touch, okay, is you found out more about them. And then after you find out something about them, you tell them about yourself, right? And then you do a follow-up a week later. Hey, thanks for that time. I just wanted to reach out and see if you had any other questions. I really appreciated it. I enjoyed talking to you and your wife, Martha. And you kind of just are laying out that you recall information about that about that conversation, which is one, good on making a personal level, but two, it's kind of a paper trail that you can show that you do know this individual in case it's ever asked by the SEC.
Okay.
So that would be like the second test. And then the third one would be, hey, I know that a previous deal you weren't able to get in on, but another one has come available. Would you like to know more about it? That's the third test, and you're good. So you've met them, you followed up with them, and stayed in touch. You get your potential investment for them to come in on, and that would be your third touch. And we would feel comfortable defending that every single time, right?
Okay.
And then the no advertising and general solicitation requirement outside of, what I mean by you can't share this on public webinars, electronic means, the internet. I mean, hey guys, Kyle Swafford here of Blue Delta Capital, and I have this deal going on right now. I'm issuing, shares at this price. Let me know if you're interested. That's a clear violation. What I tell people though is you can't get in trouble for explaining something that if someone's asking you, about your day or how things are going. For example, let's say you're at a wedding reception and someone says, hey, Andrew, how you been? Oh, good, man. Staying busy. Things are going great. Yeah. Your mom was telling me that you're in commercial real estate now. Yeah, actually we are. Things are really ramping up. I know it's a odd time right now, but we've got a LOI submitted on, a property and we hope we get it. Oh yeah. Where might this property be? Oh, it's it's in Houston, Texas, something along those lines. Well, you haven't really conveyed anything. You haven't said that you're raising capital on it. You haven't mentioned any of the terms. You're not like generally just taking the mic, and at the reception and say, hey guys, come talk to me at my table over here. You're just telling them generally about what's going on in your life. That's fine. Once you kind of know what, when you get to it, whether you're generally soliciting this offering or not.
Your quarterly returns or something, right? We expect.
Yeah, getting down into
years,
right. Exactly. Exactly. So again, just to kind of recap, that's the 506B is like you cannot have more than 35 non-accredited but sophisticated investors that you have a pre-existing relationship with, and you can't generally solicit or advertise it. 506C is wide open. You can advertise it in any means that you want to. You can rent a plane to make smoke in the sky if you want to, sure. Blaze it across the heavens. You can generally solicit it to people that you know or don't know, because the verification process is going to come from a third party. So they are all going to say either by their attorney or by their accountant or an independent third party verifying why they're accredited. And that's where you start seeing like the advertisements or, any ads or anything like that. That's where that starts coming into play. So I hope I answered your question there and kind of the key differences between those two.
Definitely. Yeah. And some follow-ups I had too. One question I had for you was on the 3 touches. How should people keep records of that? What kind of records, and is there a time limit on how long you need to keep that?
I wouldn't say there's a time limit, because it would only come up if the deal went south and that specific investor, reached out to the SEC, right? So this is probably this is just what I would do. And again, I'm a little more careful by nature. So you may say, oh, that seems like overkill. Well, it may save you. So why not? I think if I were meeting with you for the first time and I asked you, what your goals are, what your occupation is, stuff like that. Well, I would email my notes to myself.
Mm-hmm.
So then I have a record of when I spoke with you, what we talked about. Right. And then I send that follow-up email to you, sometime down the road, using that email notes that I've already saved so that I can kind of put it in there. Right. So what I've done is I've created this paper trail and this timeline of when we spoke, what the notes were, doing the follow-up and whatnot. In terms of keeping it, I mean, the email is never going to go away. Right. So it's not like you have to like print it and save it somewhere or anything like that. But I think that would be a good way of illustrating your process. And if you're doing that every single time, you say, here's what I do for every single person, I
Yep.
think that goes a long way to the extent that you were across the table from a SEC agent asking, how do you justify this pre-existing relationship with this individual? Did that answer your question?
No, yeah, that's a great point.
That's a
That's
good safeguard, I think, to have in there is
mhm.
the follow-up, the email, the communication, the note-taking process, emailing it to yourself. That way, you don't take these notes and clean off your desk one day and throw them away.
Sure, sure.
Mhm.
Now, on validating the accredited status, I know there's third party companies that do that as well. Do you typically know what the fees are on that? And then have you seen people try to do it themselves? And any guidance on that?
You can only if someone is going to make up a law firm letterhead saying that they're accredited just to get into the deal, there's no way you could have gotten around that, right? Like you're allowed to rely on reasonable means, but it does have to be verified. Typically, an accountant would probably do it for that particular investor, maybe $50, an accreditation letter, an attorney, maybe about this along the same lines. I don't know, maybe attorneys bill $25 more just for the sake of it. But, that would probably, I think that's the easiest way to go about it, effective way to go about it. But if you Googled independent third party 506C accreditation companies,
Yeah.
there's hundreds. I mean, there's so many to choose from. As far as what the fee is, I can't imagine it's north of $100. I'd be real shocked. Because there's so many of them, and it's a very simple process. Like all the investor has to do is show his net worth portfolio or show his 2 previous tax years or tax returns with his current pay stub.
Mhm.
So it's not a real heavy lift.
Yeah, no, that makes sense. Now it's kind of become popular, the fund of funds. And I know you deal with this quite often. How does that work? And what are your thoughts on that? Do you think it's a good idea to start one, or what do you think?
It depends on the person that I'm speaking with. When we talk about syndications and getting into commercial real estate, one of the first things I would ask someone that's getting into this space is, well, do you think you could capital raise? And give an honest answer here. Feel free to take a second. Do you think you could raise $1.5 million in 3 weeks' time with very little difficulty?
Sure.
If they say yes, I typically try to steer them, at least initially, as a fund-to-fund capital raiser on someone else's syndication. And the reason I'd suggest that is if you have capital, people with a deal will find you,
Sure.
right? Like
Yeah.
that won't be a problem.
Mhm.
However, just because you underwrite a deal and have a good deal doesn't necessarily mean that you'll get all the funding for it. And
Yep.
typically, if you can capital raise on someone else's deals, even yours, for example, you're going to be with a sophisticated sponsor by that point and you're going to learn how to effectively implement a business plan. If it's value add, knowing when and how and what's the typical cost. Like I don't know if you've dealt with this before. I would hope not, but someone like you probably knows the average cost to either do a light, medium, or full renovation on an apartment complex.
Sure.
Well, when you go to implement that strategy with your underlying property manager and they come back with a bid of $5,000 north of whatever that would be, well, that's going to be a red flag to you because you probably know that they're getting a kickback from the contractor that's doing the work, right?
Right.
Somebody doing this for their first time wouldn't necessarily know that.
Mhm.
So they might miss things like that. So the point I'm making as a whole is that you get in with a sophisticated management team that effectively runs this business plan. You get to learn from that. And you're obviously staying a part of the management team and group and voting on matters yourself. But you kind of get this free education you can't get anywhere else, from a team that's done this before. That's a rare opportunity. So if people can raise capital, I try to. That doesn't mean you can't learn on your own or get a co-sponsor on a deal that you underwrite. Of course, that's also a possibility as well, and quite often happens by by the nature of it, because a lender's going to require a KP on the deal anyway. So that's a lot of times solves itself. But capital raising can open a lot of other doors for you just quickly. Now, the same rules apply to a fund to fund as it would a direct to asset syndication, right? So when we were talking about syndications earlier, we were talking about forming a company to raise capital to specifically purchase a piece of property.
Right.
With a fund, we're raising capital to invest in a syndication, right? And the disclosures are a little different there, because you're no longer talking about the direct acquisition and ownership and management of an asset, but the deployment of capital into a fund for the purposes of generating revenue. So it's a little bit different. I think that fund of funds provide a valuable mechanism for capital raisers. Because, for example, let's say that I'm a GP sponsor, Andrew, and I want you to raise the entire $3 million that I need raised, and you bring your investors to the deal. Well, now I know who your investors are.
Right.
Right.
Mm-hmm.
And on the next deal, what if I have all their contact information now? It's on the subscription agreement.
Yep.
If I reach out to them, right, I don't really need you anymore.
Yeah.
So now that would be a horrible way of doing business, and but you'd be surprised that happens a little more than not. Now, I think typically the people that would pull some, swindling nonsense like that are typically going to find themselves out of this space sooner than later.
Agreed.
But it could happen, or God forbid, they say, you go capital raise for us and you'll get 30% of the GP, you get all the ducks in a row, and then they bump it back down to 15. Well, what do you do? Right. So I'll address that in a second. But the beauty of the fund to fund is that all of your investors are investing over here, and then the fund is investing down in the syndication, signing a subscription agreement. So the other GP individual won't know who those investors are. So it protects you from being removed from deals otherwise, and it still affords your investors the anonymity that they may value anyways. So that's the major component of a fund to fund. And I get it. Some people may say, well, if I come in on the GP team, they're already spending X amount on a syndication, and then if I have to do this, is it just spending a lot of money? I mean, maybe, I don't know. Like what's it worth to you to keep your investors to yourself? I mean, that's only a question that you can answer.
Right.
I have a client that on a closing wouldn't even give her investor list to a lender. Really? And you're just going to give it, and you're just, and you're just going to give it away to another GP sponsor. I don't see why you would do that. So now the way to get around some of that, some of the prevention of, decreasing this otherwise agreed upon GP split, what we recommend, and I actually talked to someone about this today, it's funny, is making a side letter. So, Andrew would send a side letter to me saying, you need me to raise $3 million. If I do raise the $3 million, then I would receive 30% in the GP company and have an active role in the management of the company, right? Sure. And you could even say and make it pro rata, meaning you only raise 2, you get 20. You did, whatever. Like you can make it, you can figure out what the core terms are there. Sure. And that gives you comfort, because now you know that you're locked in on what you need to do. And I would think if you're sending me a side letter like that, then that tells me you can close. So it kind of makes everybody kind of work together and know what the terms are. And sometimes, terms can just be forgotten. If you're a sponsor, if you've ever been a sponsor and have been stressed about raising capital before, or just initially, you've probably had thoughts with different people. And you may not know what you said at any given time, because you talked to 7 different capital raisers just to see if they were interested, let alone that they actually said yes, right? You've probably spoken to 12 to get confirmations from 4 to iron out the details with 2, right? You may not remember what you said, but or I may not remember what I said, but that's why you bring me that side letter agreement so that we can iron that out.
Yeah.
I hope I kind of answered your questions there on fund of funds and kind of a higher viewpoint of kind of like how that's worked in this space.
Definitely. And the side letter is a great point because it can get confusing when you talk to so many people trying to remember, the agreements and what you said. So
Right. And I do want to be clear too, when I say get a percent of the GP team or the GP entity, you still have to actively participate in the management of that company. I'm sure that underlying management agreement will have some sort of the members will vote pro rata on their membership interest. You still need to do that. And the reason I say that is because the SEC doesn't allow you to get anything for brokering capital, right? Like that's against the law.
yeah.
So now, but if you get voted out, you get voted out. Like, like if you get outvoted on a particular matter, then that just is what it is. But you got to be in these, monthly calls with the GP team and voicing an opinion and whatnot. If they're just going to give you some GP cut and kind of, go sit in the corner, the adults are talking.
Right.
I don't know that that's really the type of deal that you want to be in, because you're not really complying with the SEC. And if we're doing that already, then how are we going to handle further deals? So just be mindful of that. I'm saying get a cut of the company, but you still actively participate in it.
Right. Yep. And actually, just that was one of my questions, just to prove kind of how serious a violation like that could be. Do you know what some of the consequences could be, or anything you've seen, somebody get in trouble with them, with the SEC?
Well, none of our clients have ever run into those situations because we steer them away from it, with great intent and reason why. I can say this, it's kind of like having an IRS audit. If the IRS is auditing you on 2017 and 2018, that's just going to complicate things in 2019 and 2020, right? And then you're going to have to source that and validate why you did this, that, and why you're doing it now. And it just kind of slows down everything. Well, if the SEC is looking into you on, I don't know, syndication fund one, well, they're naturally going to ask, are you in any other syndications?
Yep.
If so, what are they? Well, now they're going to look into your syndication 2, syndication 3, and then if you're capital raising with another group, for example, like where it's a $15 million raise and you're bringing 3 and this person's bringing 3 and Raquel's bringing 3 and all these people are coming together, that entire GP team is going to be slowed down because the SEC is like, we want to know more about this.
Right.
It gets to a point where by the time they're investigating you, it just makes you so dead in the water that you can't further along your career in this space. And it's just not worth it.
Right.
It's just not worth it. It's not worth it for a GP stake. It's not worth it to try to get that pre-existing relationship with somebody. I mean, just the sheer, God, to defend yourself against an SEC investigation, that's easily going to be 20 grand, easily. Whether retainer or hourly, doesn't matter. So it's like I said, it's just not worth it.
Yeah.
Just stay away from that. You don't need to get into this space that bad.
Right.
That would be my advice.
Yep. Totally agree. Now, what, you deal with a lot of investors, sponsors. Do you have any, maybe 2, 3, or whatever common mistakes that you see people make before maybe they come to you and you kind of teach them what not to do?
So yes and no. Typically, someone starting to get into this space, may not know the difference between adequately prepared purchase and sale agreement made by an attorney versus signing the boilerplate broker PSA agreement. Never, ever sign a broker PSA and call it a day.
Yeah.
The reason why is there are no seller representations and warranties. Is the rent roll accurate? If it's not, so what's it to them? They didn't rep and warrant that. All they're probably repping and warranting is that we're a valid entity. We can authorize this transaction and we're located in the blah, 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 right? But the actual truth and verification of these documents, the rent roll, the T12, the bank statements, all that, what if it's just a lie?
Yep.
And you can get shady sellers sometimes. And it's not that the broker's doing anything inappropriate. The broker just, to my understanding, gets paid one or two times at the execution of the PSA and at the closing. So if they can put together a 5-page purchase and sale agreement and put it in front of you, well, that's what they're going to do, right? Whereas we would make a purchase and sell agreement that makes the seller rep and warrant certain things. We're going to fight for a financing contingency because this market is insane right now.
Yeah.
The economy, the Fed, the interest rates. We actually talked about this privately before we got on. I don't know if you're doing this right now, but most LOIs are being submitted with financing contingencies now.
Oh yeah, we definitely are.
Yeah, because lenders, we had a lot of retrading was happening before this took place, right? So, for example, we would have clients that gotten a great deal in March that did not make sense anymore with May interest rates. So, a lot of retrading was happening. Almost 10% retrades were happening left and right, and that was pretty rare for us to do at the time. But it almost became every week we were retrading, and negotiating, because the interest rates change so much.
Mhm.
Well, the natural evolution of that is, well, now that's got to be addressed in the PSA. We're not going to retrade anymore. We want it stated up front. There's a financing contingency. That's not a financing contingency. There's no way in hell that's going to be in a broker contract, right? So that's
Yeah.
kind of the way you want to go about it. So don't sign broker PSAs if you have, or if you're going to, because look, maybe it's a $1 million property. You can sign the broker PSA, but get your attorney to draft an addendum to the PSA, which says, here the seller reps and warrants the following things: 1, 2, 3, 4, 5, 6, 7. At least get some sort of coverage. Like I get, it's not particularly cost effective if the purchase price is so low. Fine. I guess I can be open to that argument, but do something. Don't just sign a sign a broker contract. Another thing that I think new sponsors probably do is that I don't think that they initiate a hurdle, an IRR hurdle in their offering like they need to. And a hurdle, as you know, is kind of where if we have made your money back and some in a quick and effective manner, it used to be a 70-30 split. But if we get you a 16% return on your money within a certain amount of time, it goes to 60-40.
Mm-hmm.
Well, the reason why that's important is you're probably refinancing out of this property in year 2 or year 3. So hitting that IRR hurdle happens almost, within half the time of your business plan. And you're otherwise leaving money on the table that could have otherwise been there for you. And for you to make them that kind of money, there's a real value in having that win-win relationship. I could probably do a podcast on you and you telling me all this stuff, but so much goes into the underwriting, so much goes into the due diligence, so much goes in the interest rate caps, insurance, loans, capital raising, dealing with the investor relations.
Mm-hmm.
Just to close, then to close of doing the business plan,
Right.
discussing whether we refinance now, and making sure that your loyalty to your investors mean that you'll take a job bartending before you lose their money, right? Like you got to make sure that the deal makes sense for you as well. That's all I'm saying. And if you can do that in part with a win-win scenario by implementing an IRR hurdle, I think you got to do it. But I can tell you that the clients that I have where an IRR hurdle is not implemented are newer into the space, and they slowly grow out of that.
Yeah. It's interesting you brought up the financing contingency. I didn't tell you this, but we just lost a deal actually. We went in same purchase price as the other buyer, the other group, and we lost it because we refused to waive the financing contingency. And they went in with no contingency, but today alone we're looking at maybe 75 basis point raise. I mean, that could be a big deal.
Oh, I know. And I think too, look at us speculating about the future here with our crystal balls. But, I think what you're going to see is that a lot of people made a lot of money buying in 2018 and 2019, selling high in 2020 and 21.
Yep.
I think what you may see is a lot of those people that bought in 2020 and 2021, not anticipating and really stress testing their underwriting, are
Mhm.
going to see the downfalls of that in the upcoming months and quarters. Because if they didn't stress test that variable interest rate at 8% for an entire 6 months,
Yeah.
and or not getting the rent increases that they thought they were going to get, you're going to start seeing a lot more properties on the market.
Oh,
And
yeah.
what has been a seller's market is about to be a buyer's market, probably.
Mhm. Yep.
I obviously, I'm never advocating for anyone to lose or anything like that, but I think that people that might not have anticipated an adequate underwriting process, or did not anticipate what could happen, and did not have an adequate underwriting process, are about to see that, they might be under right now,
Yeah.
with the way the interest rates are going, and may not be able to cash flow it like they thought they could. And I think you're going to start seeing a lot more properties become available for that
Yep.
reason.
I believe I heard this was like the fastest interest rate hike in history as well. I mean, they're raising
Hmm.
rates extremely aggressively.
Hmm.
That's a really good point. Okay, how would somebody contact you? Do you have an email or a phone number? How do they find you?
Sure, absolutely. So, on LinkedIn, you can find me. My name is Kyle Swafford, KYLESWAF as in Frank, F as in Frank, ORD as in David. My LinkedIn profile is a bit more professional. I don't look like some hipster in Nashville about to go brewery hopping or anything like that.
That's funny.
But you can find me there on LinkedIn. My cell phone is 662-588-1990. If you want to reach out and have any questions kind of getting into this space. And you can also reach me via email at Kyle, Kyle, at rfllplaw.com. One more time, Kyle, Kyle, at rfllplaw.com. And if you do hear about me because of this podcast episode, or I believe a YouTube channel as well, please reference that so that I know that where you came from, and I have some sort of context as to kind of where, my name came up into this. If you just say, "Hey, Kyle, I heard about you," I don't know if that might have been at a conference that we might have both attended or anything else. So referencing this podcast would go a long way, and we'd really appreciate that.
Great. So now we get into our five to thrive section.
Okay.
Basically, word association game. So I'm just gonna rattle off 5 words, and you just kind of give me the first word or phrase that comes into your mind based off
Okay.
that word. The only caveat is you cannot repeat the same answer.
I cannot repeat the same answer. Okay.
Mhm. Okay.
Okay.
So the first one is capital raising.
Uh, Power and leverage.
Multifamily real estate.
The best time to start was yesterday.
That's a good one. Syndications.
Easier than you think.
Passive income.
Well, your selling point
Right. Yeah.
to investors.
Exactly. And Kyle Swafford.
Just a transparent guy. I've never really thought of myself as, Kyle Swafford, this, sophisticated commercial real estate, attorney in Atlanta, Georgia, and all that. I'm just me. I happen to do that. I just try to be transparent and honest with clients because that's what I'm expecting of them.
Right.
So,
You're, you definitely are a great resource. I mean, I would recommend everybody reach out to you. That's for sure.
thank you, Andrew. I appreciate that. But yeah, that's just what I am. I'm just a guy from the Mississippi Delta that's here in Atlanta, and I'm looking to help as many people as I can and get to know as many people as I can. So yeah, just I guess who is Kyle Swafford? Just down to earth guy. I don't know.
Yeah, I like it. That's
Thank
awesome.
you. Sorry.
No. Well, I appreciate it, man. I really, really appreciate you taking the time to come on the show, and it was a great episode. And thanks for being here.
Absolutely, Andrew. Thank you again for having me. I really appreciate it.
Welcome back, everybody. We just have a little update on our Kyle Swafford interview. So the SEC has changed some things on converting a 506B to a C while in mid raise. So we just wanted to update you guys. And Kyle's back to kind of go through that with us. Kyle, thanks for coming back on.
Hey, man. Thank you. Appreciate that, Andrew. And yeah, when we first spoke, the SEC had released that, it was an option to convert, but it was kind of like, whenever you see tax policies change where Congress has said, we're going to limit the research and development tax credit. And then people relying on that are like, okay, well, how are you limiting it? And then, a year and a half later, the IRS says, well, this is how we're going to go about it. And then everybody's kind of amending and nobody really knew what the implication meant. And since the ruling came, there's been a lot of clarity on what that looks like. So basically, as will have been discussed, previously in this recording, let's say that you have a 506B offering. It's important to distinguish this is a B to a C, not a C to a B. You cannot go backwards. So follow the alphabet, B to C. Okay. So when you start with a 506B, let's say that you need to raise $5 million, right? And between your network of investors, you're at about 2.5 million, maybe half of it, maybe you're at 4, whatever your number is, you've recognized that you cannot meet the rest of it. And maybe you've capped out the 35 non-accredited investors. So another capital raiser that could have helped you would have relied largely in part on non-accredited, and there's the cap, and that doesn't work either. Well, one of the things that you can do is convert that 506B to a 506C. Now, it's important to note that if you do that, you're terminating the 506B. So when you terminate it, you can no longer take subscriptions from that 506B offering. So if you've got a non-accredited investor that has said, yes, I'm interested for $100,000, and you go to convert or you've converted and you terminated, you can no longer take that $100,000 anymore. You want all of the non-accredited investors to be fully subscribed and fully funded. The reason I distinguish the non-accredited is because the accredited investor could have been in either deal, B or C, but a non-accredited investor, you're going to want fully subscribed so that there's no question as to when that officially terminated. One thing that we recommend doing, and let's use like some dates here, depending on when you hear this recording, it can change, but let's just assume we're starting October 1st. You've got your PPM documents on October 1st and you're sending them out, and ahead of time about what your soft commits are going to look like. So you say, okay, October 15th, we're going to terminate the B. That's our plan, right? Maybe you give that a couple of days, maybe it falls on a weekend, whatever, but you give that's your date. That's your plan at least. So what you want to do is you want to have something like maybe a company resolution put in the minutes, and everybody, all the members come together and agree on that, or the management team comes together and says, okay, on October 16th, we are terminating on October 15th, starting the 506B offering on October 15th. Starting October 16th, we are only going to pursue investments through a 506C offering. Accordingly, the 506B is terminated, and we will now issue Class C units, right? Maybe you had Class A units for your investor. Now we're creating, if there's 1,000 shares left over or 1,000 units left over, you're going to say we're, terminating the 1,000 remaining Class A units, converting them to Class C units, and the Class C units will be available moving forward. So what does that look like from an SEC compliance standpoint? Well, you have Class A units or B units, whatever you had a class of units for the 506B offering. You have an entirely new set of units for the new 506C offering. You have a company resolution clearly indicating, that you terminated the B and you went forward with the C. And then all subscribers moving forward are getting C units. So it's not only is it clear from the date of the subscription agreement and as it relates to your company resolution, but the unit itself is different than previous units. So that's where, that's how that we're recommend going about this. Obviously, if you indicate to your attorney, mid-raise that you need to do this. You might need to amend the operating agreement as it stands, allowing the manager the right to do this so that the manager can go about it. We're noticing this happening more and more because, maybe your investor pool is a little skittish given, either the political climate or the economic climate right now. And maybe you need to solicit. Maybe you need to advertise to close. We're seeing far more conversions now than we have before. In the same way, a couple of months ago, you saw more retrading than you ever had because interest rates rose, right? Now you're seeing more conversions in large part for the same reason.
Okay. One question I had, so I guess you don't have to go back to your initial class of investors and have them refill out paperwork, right? It just automatically transfers over to the new shares.
It just automatically transfers over. Now, keep in mind, you were doing a 506B offering. So when that closes, you need to go ahead and file your Form D and your blue skies on the investors that came in the 506B offer.
Okay.
When you've converted, you now have a 506C offering. So now you need to file a Form D for your 506C and new blue sky filings for the investors moving forward. So you're not filing on anything previously. Like let's say it was a $5 million raise and you did 2.5 and 2.5. Well, when you convert, you're not doing a raise of 5 million. That was already covered in the B. So you're doing a raise of 2.5. So in the same way, when you go to do your blue skies, you're not listing the investors that have previously come in. Now, suppose an accredited investor that was in the B says, "Hey, I'm willing to give an extra $50,000," and then he comes in as a C. You would list him, right? Because that's a new offering. But I think I kind of made the point there.
Yeah.
But it's two separate offerings, two separate Form Ds, two separate blue skies.
Okay. Cool. Awesome. Well, I appreciate it. Yeah, that's great information to have, especially like you said, it's happening more and more now. So, and this is slated to come out next week, so it's actually perfect timing.
Good. Well, perfect. I appreciate it.
Cool. All right. Thanks, Kyle. Appreciate the update.
Absolutely.
And then one more time, actually, if you don't mind giving your contact information one more time.
Sure. People can follow me on LinkedIn. My email is Kyle, Kyle, at rfllplaw.com, Robinson Franzman LLP. So Kyle at rfllplaw.com. My cell phone is 662-588-1990, 662-588-1990. And if you don't mind mentioning this podcast or this interview as like a subject line or in the voicemail or anything like that, just to kind of let me know where you heard about me so that it kind of helps me figure out what I discussed in that moment so that I kind of have a context as to why you're reaching out. That would be greatly appreciated.
Great. Awesome. All right. Thanks, Al. Talk to you soon.
Absolutely. Thank you.